Mistake number 6 of 10 when saving for retirement. In this episode, I'm answering the question, what mistakes do people make when saving for retirement? Now, there are tons of mistakes that I've witnessed people make, but this is mistake number 6 of the top 10. Get ready. A lot of people make this mistake, and it's because they're told to do so by their accountant or their tax attorney. So, my name's Doug Andrew, and I've been a financial strategist, a tax minimization specialist, and helping people prepare for a comfortable retirement where hopefully they will not outlive their money. And I've been doing this for more than 47 years. I've been very blessed and honored to have written 12 books thus far. And at the end of this episode, I want to gift you a copy of my most recent best-selling book that's been flying off of the warehouse shelves as a token of appreciation. This particular episode is one of the big mistakes that I've seen retirees make. I would encourage you to watch all 10 episodes in this series to learn about the top 10 mistakes, because I've seen thousands of people make these mistakes. Are you ready? This is mistake number 6. People, when they sock away money, usually in traditional accounts like IRAs or 401ks, and if they don't need the money at age 59 and a half, when they could access the money without a 10% penalty, which is mistake number 5, leaving it there. But oftentimes people would come to me after they were already the age of 70 and a half, is the age it used to be, where you had to start taking money out of your IRAs or 401ks, or else the government would assess a 50% penalty on top of the tax. See, the government wants that money out in tax before you die so they can tax it again when you do die. But here's the mistake people make. And now the age is age 72. The mistake people make is thinking, well, if I don't need the money, I should only take out the required minimum distribution. That spells the acronym RMDs. I cannot believe how many people are told to take out RMDs starting now at age 72. That's the worst advice in most cases that could ever be given to these people. And when CPAs and tax attorneys come through my advanced continuing education, they go, oh my heavens, I thought I was saving my clients money by telling them, by advising them to take out RMDs, thinking it was saving them tax. I was only looking at the short run. It was a very myopic, short-sighted, instead of looking at the big picture. So let me explain why, so you can avoid this mistake that's being made by hundreds of thousands, maybe millions of Americans every single year after age 72. So why does the government have this rule anyway? Well, if you haven't figured out, IRAs, 401ks are usually the best savings bond the government ever came up with for themselves. Do you know that the federal government actually plans their budget, their spending based upon their income, not only from normal income taxes while people work, but they know how many people are retiring. They keep track of how many are turning age 72, and they haven't been able to tax these people yet, and they must start withdrawing money based upon the government's life expectancy formula so they can start getting that money taxed. They've been planning on the revenue for a long time, and if you bugger that up, they're going to penalize you. How much? 50%. So let's simplify this. If you're age 72 and your life expectancy is 20 years, to keep it simple, That means if you had $1 million in your IRAs, 401ks, or whatever, and your life expectancy is 20 years, you must take out 1/20th at age 72, or $50,000. If you do not take out $50,000 and pay tax on that to the government, they will penalize you $25,000 on top of the tax. They'll take 70, 80% or more of it if you do not start taking the money out so the government can get their share. They've been planning on this tax revenue, okay? And they're dead serious about this. Now, what about when you turn age 73? Well, now your life expectancy is 19 years. You have to take out 1/19th, the next year 1/18th, the next year 1/17th. And so every year you have to take out more and more out of your nest egg based upon your LE, life expectancy. The government will penalize you 50% on what you should have withdrawn if you don't do it. They're that serious about this. So most people, when they hit age 72 now, their accountant, their advisor asks, well, would you like to save as much as you can on taxes this year? Well, what's the answer? Most people go, well, yeah. Well, if you don't need the money, then just take out the RMD, required minimum distribution, thinking that saves them tax. It might save them tax in a given tax year, but I developed a software program years ago that would show people the darkness of the night, so to speak, if they followed RMDs. And they took out the required minimum throughout their lifetime, their spouse's lifetime, and then as it passed down to children. It used to be children could hang on to it for their retirement, but now children who inherit IRAs and 401ks must pay the tax on those IRAs or 401ks within 10 years. And so most CPAs and tax attorneys, when they get educated, realize the worst place to leave money when you pass away is in IRAs and 401ks as it passes down to non-spousal heirs. It could even be subject to estate tax on top of the income tax, okay? So what should you be doing? Instead of taking out the minimum distribution, I would show people by age 70 and a half, and frankly, for a lot of people, I started at age 59 and a half, like the story I told in the fifth mistake in this series. But for sure, by age 70 and a half or age 72, don't take out just a required minimum distribution. Let's take out as much as you possibly can within your tax threshold. And oftentimes, that is far more than the RMD because you want to take advantage of tax rates today because your current tax bracket is likely the lowest bracket you will ever be in. If you're like most Americans, you realize that taxes in the future will likely be higher. At the recording of this episode, we're looking at President Joe Biden with all kinds of tax increase proposals. So why do you want to wait around for taxes to go up to take out money? Pay the taxes now sooner than later on all kinds of things. This is why a lot of people are selling highly appreciated assets to pay capital gain taxes at 20% instead of 39.6% where Biden wants to take them. You want to look at paying taxes now. You will want to get the taxes over and done with, then reposition the money into something that's going to be tax-free from now on. These are called strategic rollouts. Let me give you an actual story, an example of a gentleman that came to us when he was 70 and a half, and he was told to leave money in his IRAs and 401ks and take out RMDs. He was blown away by the illustration I prepared for him. So if this is resonating with you and it has you concerned, be sure and share this video, post a comment, click like, but subscribe to the Three-Dimensional Wealth channel. Why? Because I have over 500 educational videos like this on this channel. I'm passionate about empowering you, and I post at least 5 new educational videos on a weekly basis. And so subscribe to the channel and stay with me to the end because I want to empower you to learn more about how to correct these mistakes or avoid them in the first place. And you can learn how to do that by reading and studying my most recent best-selling book. And I'm not trying to sell you the book. I will gift you a copy. You can click on the link below, laserfund.com, to claim your free copy by contributing a nominal amount towards the shipping and handling. Let me share with you what we did for this gentleman. He was a real estate guru, and his wife had just passed away. He was 70 and a half, and so he now had to start taking out required minimum distributions. According to his advisor, that's what he was told to do. Take out RMDs. Now, he had $600,000 in yet-to-be taxed IRAs and 401ks. That $600,000 had dipped below $360,000 twice in the previous decade. This was from 2000 to 2010. He came to us at the end of 2010 and he goes, "That was the worst decade ever. My $600,000 dropped down 40% twice. It's barely back to $600,000. Because of that, my advisor is recommending that I do a 4% payout. That's called the 4% rule in the financial services industry, because the average person who has their money in IRAs and 401ks in the market is only earning 3.49% average, according to the analysts like Dalbar that study investor behavior. And so 4% on $600,000 was $24,000 a year. Now, I don't know if you're like me, but I don't save up $600,000 to have a measly $24,000 of income. But that was the RMD. If we took out just the interest only, he was allowed to take out about $24,000 a year. He has to pay tax on that. In a 33% federal and state bracket, he had to pay how much in tax? $8,000 of the $24,000. He was netting $16,000 to buy gas, groceries, prescriptions, and golf green fees. Pretty pathetic, right? You wouldn't believe how many Americans get talked into doing this. We took him and his $600,000. We were able to secure a more predictable rate of return. He averaged about 7.9% for the next 5 years, and we did a strategic roll out. Not a rollover, a roll out. We took his $600,000 and it grew to $750,000 in the process, but he took out $150,000 each year. That's more than the RMD. He had to pay a third of that in tax. You pull out $150,000, he pays $50,000 in tax. He's only netting $100,000 to reposition into my favorite vehicle, the tax-free laser fund. It was smart. It hurt, but he was glad he did it. He wasn't going to save tax by taking RMDs. Long story short, this is what we did. In 5 years, he took out $150,000 a year, paid a third, $50,000 in tax, netted $100,000. He put $100,000 a year into my favorite vehicle, which is called the Laser Fund. It accumulates tax-free, and he's been earning between 8% and most years over 10% on his Laser Fund tax-free. Now, he paid $50,000 a year in tax over 5 years. That's $250,000. Most people go, "Whoa, you just forced him into paying the most in tax." No, we didn't take his tax bracket any higher than he already was. He was already in the highest bracket. We got the taxes over and done with, $250,000, and we netted $500,000 in his laser fund portfolio. The $500,000 is tax-free now. At 8% on $500,000, that's generating $40,000 a year of tax-free income. Most years he's earning more like 10%. What's 10% on $500,000? $50,000. How much more is $50,000 than $16,000? We more than tripled his net spendable income. We were able to create more liquidity, hence the L in laser. It's this pillar here. Safety of principal. He doesn't lose when the market goes down. We're using indexing. We're getting predictable rates of return of 8%, even 10%, which is more than double or triple his after-tax return in his RMDs on his IRAs and 401ks, and we converted to tax-free. He was so grateful, and now when he dies, the $500,000 blossoms to $1,250,000 and transfers tax-free to his children. There's not an IRA or 401k around that will do that. So, as I often say in these episodes, I felt like Sam I Am in Green Eggs and Ham. You will like this. You will see it when he was paying $50,000 a year in tax. But at the end, when we tripled his income, and now we're not only generating this much more in income instead of this, but when he dies, we leave behind much more than this. Why would you generate this much income when you could generate 3 times that? Why would you leave behind this when you could leave behind this if it doesn't cost you anything? He was saying, thank you, Sam I Am. I like these green eggs and ham. You can correct this mistake before it's too late. Don't just take RMDs thinking it's going to save you tax in the long run. When you add it up, you are compounding the taxes, and you can correct that mistake before it's too late. Learn. The story is in this book. This white side is 200 pages with all the charts and graphs and explanations of what I'm talking about here. You will want to investigate a laser fund or a portfolio of laser funds for you. If you learn more by stories and examples, you can flip the book over and read this side. This is 100 pages, 12 chapters with all kinds of stories like the ones I just shared with you. So folks, click on the link below. Claim your free copy. I'll pay for the book. You contribute a nominal amount towards the shipping and handling. I'll fire out a copy to you. You'll see why so many people are eliminating the mistakes. They are correcting them before it's too late. And please watch the other episodes in this series so you understand all 10 of the biggest mistakes retirees make.